Tushar Pradhan, CIO at HSBC Global Asset Management, joins us in the show right now. Tushar, hi, morning. You know, the chatter just a week ahead of the budget is all about what the markets want. Do you think the market is going in with high expectation and anticipation as to what the finance minister can deliver in a week from now?
Yeah, I think expectations generally around budget is always very high. But this time, I think the budget expectations are not something to do with what next, but it is actually what does the government do to as a reaction to what's happening in the economy. So it's more of an expectation of what is the measure to get us out of the trouble rather than what next and how great it is going to be. So I think this time the expectation is really to see how the tightrope that the government has to walk between, managing the fiscal deficit and then trying to ensure that there is growth in the economy. These are actually counter to each other. So I think that's really where the expectation is coming from, to say which side does the government tilt. And that's really quite interesting to see now.
If the fiscal deficit, Tushar, stays below 4% but goes higher from 3.3 to let's say 3.7 or 3.8, do you think markets would like it?
It's a very, very interesting question because it depends on which market. So clearly, if you look at the situation from a bond rating perspective, I think they are also very keen to ensure that the fiscal path remains pretty secure. And the bond market may not like it. But the equity market may like it because it might be looked at as a growth incentive to saying that, look, we are willing to sacrifice fiscal prudence for a little bit. But we are actually giving you something as an incentive to grow, and as a result of which I have increased my fiscal deficit, so that's fine. So I think these markets will remain divided depending on what sort of investor you are. I think clearly lower numbers in terms of achievement of this deficit will lead to even a weakening of the rupee. There are other markets which will get affected. So the question here is which market. But clearly from an equities perspective, it might be a sign that the government is really, really interested in ensuring a return to growth. So the jury's out. We'll have to see which market takes it in which way.
Indeed. Tushar, so what are those 5-point expectations that you and your colleagues at HSBC are, placing your bets on when it comes to LTCG, when it comes to DDT? Enlist those 5 points that you'd be looking at for, particularly which would please the equity markets. I'm being specific here.
Yeah, I think, we all have our wish lists, and it may not stop at 5. So we have, a significant number of asks. But if you look at really what the equity markets want is some incentive for the private capital to start investing again. And I think that comes at probably the topmost priority in terms of what the government needs to do. And I think that doesn't really mean any change in law or any incentive really, but maybe some significant announcement which helps people to come forward and say, well, now is the time to put my money down on the ground. I know it's a secure environment and that I can hope to kind of come in and put up capacity. People talk about lack of demand and that being the reason for no capacity investment. I don't think that's really true, because many times if you look at how corporates invest, they probably invest at a time when there is really no growth. Because by the time it reaches capacity utilization, they're actually busy doing the production and trying to make sure that they can supply the market. But that's not the time to invest. So these are the times that an entrepreneur or even an industrialist will look back and say, look, I should have some access to capital, and I know the market is slow now, so let me invest in some capacity, because once the demand starts to pick up, I should have enough capacity and I'll make the money in that cycle. So I think the government needs to kind of think about it to say, what is it that we can do or say which will ensure that private capital will be induced to invest. I think that's number one. Second is try to make sure that the banking industry, which is a very large source for capital for most of the companies across the board in India, is felt secure to lend. So coming from the first point, the second is that the environment should be such that banks should also be enthused to go out and lend and start a new cycle. The third is to ensure that we don't have any hiccups when it comes to regulation or any confusion regarding any cross-border or any such event which industry will hesitate before making any point. So I think there is a lot of talk in terms of how we can make terms of trade easy, how we can make the GST a lot easier to implement and easier for people to participate, so on and so forth. So I think these three come to mind in terms of the top priority. The rest is just the follow through in terms of how and what that means for enactment. But I think these three, if we can get through, we are on for a very, very significant period of growth in the economy.
Tushar, every year we start with an assumption of 15 to 18% earnings recovery. It's just a coincidence. Today I have last 4 years of Jan reports from all brokerages. And by end of December, they say, okay, this has gone wrong, that has gone wrong, next year will be better. When do you think markets and fund managers will start losing patience? We are all optimistic. That's the reason why we are on equity markets. But somewhere optimism aside, realism has to take over. How much more gap do you think, or how much more benefit of doubt do you think markets will give to earnings?
That's an interesting question, Nikunj. I think if you look at what has happened in the equity markets, we tend to confuse the headline with the reality. Here, what I'm talking about is that there are certain companies, while through the headline being flat, as in terms of the markets saying that earnings have been either flat or really single-digit earnings growth for the last 3 years running, and people worrying about the fact that the earnings are not coming because every quarter, as you say, there was some reason or the other. But there are companies who have, through this period, significantly given you compounded 20% plus earnings growth, and they start getting reflected, and these earnings start getting reflected in the prices as we go along. So I think it's a two-tier picture that we look at, but when we put it all together, we look at the index and you say
be called as a compounder for the decade gone by. And Tushar, that's really been the private banking space. Do you think private banks will continue to churn and will continue to create the kind of wealth they've created in last 10 years?